Okay, now we arrived at lecture 8. This is financialization of energy markets and oil price spike of 2008. We have two guests here. This is Bahattin Büyükşahin here. You can say hello, Bahattin.
Hello. Hello, everyone from Washington, D.C.
And from Paris, we have the mighty Sohbet Karbuz.
Hi, everyone from Paris.
All right, so this week, I forgot to change that one. What we are here now is, we are in the financialization energy markets and oil price spike of 2008. We want to specifically hear from the actors of the game, which is Dr. Bahattin Büyükşahin, who has been in CFTC during 2008 and has written numerous reports and articles about it. So we will, for this week, we divide into two pieces. We have one other guest as well. So two of our guests, Bahattin and Sohbet, will going to tell about contrarian views of whether the financialization of energy markets caused this price spike or not. We do not expect any bloody fights, but you know, it will be an intellectual challenge.
We'll see that one.
I think everyone is, look, if, to be honest with you, Bahattin Hoca, Professor Büyükşahin is one of the best known people in this area. And then Sohbet Karbuz, he's like the genius of this area. So we'll talk with them. Maybe in Turkey, most of you do not know Professor Büyükşahin, but this is his scholar page. He's not updated from the Canada, Bank of Canada maybe, but his articles on speculation, commodities, cross-market linkages, and those speculators drive crude oil future price has huge citations. So if you want to talk about speculation and whether speculation drives these crude prices, he's the man you have to talk globally. And our guest from next week has known Professor Büyükşahin very well, and he said best wishes to you. So we will treat you well. So he will want to join us too. And with Sohbet Karbuz is a polyglot in energy business. He's master of energy statistics. Really, if you want to ask anything about statistics, he's the guy, and he has worked in IEA for several years in the statistics division. He's a professional on US Army energy consumption. He's also well known for his writings about East Mediterranean, especially Egypt. And he has, throughout the years, when we first met him, he has made lots of models and scenario studies, and he has written numerous reports. But for this lecture only, he will talk about 2008 price spike, whether there were fundamentals behind it, or whether speculators have drawn that. So if we come to why this is important, if we come to the oil price and recessions, this is from the basic research, that from ResearchGate and others you can find that high oil prices cause recessions. It's not the time to talk about recessions maybe because oil prices are record low now, but remembering why they move like that and how they interact with economies is very important. So energy and economy relations are very important. And we have to know about, before coming to 2008, oil prices has already hit this record high increase to $70 before 2007. So prices has lost its anchor during these years, especially after 2002 and 2003. There may be several reasons for it. Maybe China, it might be speculation, it might be this Clinton signing this law about leaving the speculators free of charge, and they do other things. But in 2000, I hope the Professor Büyükşahin remembers this one. This is a report, and I would like to give this just 2 or 3 slides to remind you who are the actors. The Professor Büyükşahin is one of the writers of this report. This has been asked by US Congress to tell to the public, or to the public at large, whether the speculation was the main motivation behind this 2008 oil price spike. So in the report, it shows that half GDP growth, but oil production didn't, and half GDP increase and oil production didn't, and how the exchange value of dollar has decreased, And also it has an interesting table, probably prepared by Professor Büyükşahin, about whether they drive this change and their statistics value, because Büyükşahin is an expert on econometric models as well. So this is an important one. So you have to check that report. Then on the other side, the fellows of Mr. Karbuz, Dr. Karbuz, oil drum guys, which I have been a fan of this webpage, they referred to this report as speculation my a $. So this was their reaction to that report. And in 2008, oil prices hit $147. This was the record of that time. It was unbelievable. And during that time, everyone was talking about $200 per barrel. And they were thinking that it's still cheap. I would like to show you that this is from the Oil Drum webpage. The news during that time, if you check this, Matt Simmons, Gordon Brown, Al Gore, with the high oil prices, energy future has changed forever, like that one. Gordon Brown has set ourselves on a new energy path. The same time as high oil prices, England has started this initiative, a path from our economies that are today over-dependent on oil towards the post-oil energy economies of the future. Post-oil energy economies of the future. This is UK. Let's check about Al Gore. And this is the Al Gore's plan about it. Al Gore has made a major speech in Washington this morning, setting out an ambitious goal for US to produce all of its electricity from carbon-free sources by 2020. So it was actually ambitious targets coming back due to high oil prices. So the floor is Professor Büyükşahin's, and I'm stopping the share here. So he will introduce himself and he will talk about his presentation. There are no time limits.
Okay. Now, can you see my slides? Perfect. Thank you again, Barış, for great introduction. I'm Bahattin Büyükşahin. As I said, I was working for Commodity Futures Trading Commission during the 2008 oil price spike. That's when we started analyzing the role of financial players, not only speculators, but financial players in the price formation. That's when we wrote more than 10 articles or something on the issue. Then I moved to learn about physical markets to International Energy Agency 2010. Again, but my role over there was to analyze the linkages between physical and financial oil markets. And then I moved to Bank of Canada and Abu Dhabi Investment Authority to energy issues. But today, I'm going to talk about the price of oil, especially during 2008 financial crisis. I'm going to call this one fundamentals versus speculation, or data versus politics. The reason I say this one, data versus politics, much of the discussion on the role of speculation is about politics. People do not look at the data. Instead, they focus on what they want to say. They always try to blame someone. Of course, it is easy to blame speculators, but they forget one thing. Without speculation, there is no future. You can consume today, but if there is no speculation, there is no future. Just think about yourself. If you are buying a house, would you buy a house if you don't have any price forecast or prediction for the future? Or if you believe price of the house you are buying is going to go down, Are you going to buy it? Of course not. If you are not shorting the market, you are not going to buy it. So everywhere there is speculation. But the thing is, since all this speculation, there's always blame, especially from politicians. They do sometimes bring some regulation or something, and then they don't want to take any responsibility. It is better to blame someone. So it is the speculator in this case. So let's move to, let's look at first. Of course, I'm talking about fundamentals value. Here, you know that almost everything can affect oil prices. We said demand factors, supply factors, OPEC policy decision, geopolitics, expansion bottlenecks. You remember in 2012, 2013, in the shale business, there was not much pipeline. So we had WTI become a local product rather than international oil, or supply costs, spare capacity and inventories, demand growth, price subsidies, everything, almost everything can affect oil prices. Of course, commodity financial markets can also affect oil prices. There's no doubt on that one. But the effect of these financial prices are really not the primary driver of the prices, but they can amplify physical markets impact. I want to remind you one thing. Whatever it is, you are a financial players, you are getting the information from physical market. If the physical market is not transparent or sending you noisy data, your decision to buy or sell a futures product based on those information, of course, if those information not correct, prices can deviate from fundamentals value. But that is not, that cannot survive long. That's why we always go back to fundamental value. Of course, here in this situation, price inelasticity is the key factor. Why we saw price rising to $147 in a very short time period. Of course, let me see. We can see what changes, what causes the price change, technological shock, shale production. It is a very important determinant now, especially 2014, price collapse from $100 to $20. Or demand shock. Just think about coronavirus now. We are talking 30 million barrel decline in April. So it is a very big thing right now. Or the policy shock, resource nationalism, or impact on investment, or export restriction can impact oil price. The shocks. It is really, really important. 1970 oil shock or Libyan crisis, or Iran embargo and everything. Natural disaster on another side, another big influencer. Hurricane Katrina and Rita, Japanese earthquake, you can talk many. Many drivers of the volatile price, of course, but the longer term trends play also a role. Here, price inelasticity of supply and demand mean that relatively small change in each can have X-aggregated impact on prices. Of course, the expectation for future fundamentals and uncertainty, and also the data on those. It is important because if the data is not good, there's some divergence from fundamental value. Well, so everybody's asking this question: can 70% price change be justified by fundamentals alone? This is the question. This is one politician saying prices cannot fall or rise by 75% when you have a decline in demand of only 5%. Clearly, prices are driven by something other than fundamentals, especially speculation. I mean, this is, we know that it is completely wrong. If you take Economics 101 course, this is highly inelastic supply curve mean a tiny demand fluctuation causes highly volatile price change. Equally, inelastic demand means a small disruption or curtailment in supply price to move substantially. For example, I'm going to give you an example here. This is Jim Hamilton calculation. Low price elasticity of demand means small changes in demand or supply can produce a big change in prices. Price of oil at the end of 2004 was $50. In 2011 real prices. If we assume price elasticity of 0.1, price should be expected to $147 in 2008. If we assume price elasticity of 0.2, price should be around $86. It means that if price elasticity is about 0.1 at that time, then the question is, was it? And as I said, basically, in the short term, sometimes oil demand and supply likely to be completely inelastic due to structure of oil market and pricing practice in the industry. So some other factors can impact the oil prices during the short time periods. However, eventually market goes back to fundamental value. So the question is, how are we going to deal with this highly volatile markets? So in this case, we need both transparency, better transparency, both the physical and derivatives markets. We need via price liberalization and level investment playing fields, and ensure market liquidity and ability to hedge are retained. If you don't have futures market or speculator, your ability to hedge actually is limited. So you cannot actually hedge against volatile prices. So it is better to have highly liquid futures or derivatives market to help actually producer, manufacturer, and commercial players, basically. Of course, you need to, to have a much more stable market, more predictable, harmonized international policies on climate change, fuel qualities, alternative fuels, and investment terms. And also, you need to encourage energy efficiency. So let's look at now 2008-2009 oil shock. What are our stylized facts? All right, here is the deal. Up until 2004, prices are really, on average $30 or something. Then prices start rising to 147, and prices suddenly fall from July to December from 147 to $32. And as Barış was telling, Goldman Sachs actually was predicting $200 oil prices by December of 2008. And suddenly prices collapsed. But the thing is, especially what happened during the price surge from $40 to $147, then from $147 to $30, and then later on, after the Lehman crisis, later on prices start rising again. This is the first fact. We had an elevated price levels. Second fact is volatility during this period was very, very high. It is maybe temporary, but it was high. Aside from 1990 to the first Gulf War, the volatility was the highest up until that point. Volatility was really, really high. Of course, you can say price of oil, like those of other commodities, are inherently volatile. Varies over time. During our calculation suggested conditional volatility estimation, 2008 volatility was really temporary, increase in volatility temporary, then it returned back to historical average. One other stylized factor is increased participation of MMPs. MMP, what I mean by MMP, managed money trader position. If you look at 2000 markets, WTI shares, almost 75% commercials. Basically, what I mean by commercial is the hedgers. It might be producer, manufacturers, or wholesale dealer, or swap dealer. I'm going to come back to swap dealer because it is kind of different, because swap dealer can serve commercial players, because they are serving, they are what's called serving in the over-the-counter markets. Whatever they do, they take the opposite side in the exchange market so that they hedge against their position. So in 2000, almost 75% commercial, while only less than 20% non-commercial, including managed money traders and flow broker and traders. Managed money traders, basically hedge funds, if you call it. In 2005, we see, after especially financialization starts in 2004 or something, we see commercial share start declining to 60%, and then non-commercial start increasing to 40%. Much what's called higher. So this is the question. You see, while we are seeing non-commercial share increasing, so does prices. So it must be some link between price of oil and the position of managed money traders. This is the idea supported by some defunct hedge fund player named Michael Masters. He lost a lot of money during his play with the oil prices. So anyway, I'm going to come back to that one later on. And 2013, we see almost same share of market between commercial and non-commercial players. So here is the deal. Strong positive correlation between net hedge fund position and prices. This is the bottom of the argument suggested by those who argue that speculators are behind price surge in 2008. This is, some suggested no, because this is just a correlation, it's not causation. But we will come to econometric studies later on. One another stylized fact, there is broken relationship between prices and stocks. This is two endogenous variable actually. We are talking about price and inventories. There is negative relationship. Then after 2003 to 2013, we see some kind of positive relationship, which was not expected. So, and then sixth stylized fact, increased participation of commodity index traders. These are what I call passive investors. These are stupid money. You are in pension funds, for example, and you want to have some exposure to commodities to hedge against inflation or portfolio diversification purposes. You invest some of your asset under management in commodities. How much of it? Sometimes 5%. Where do you invest? Some GSCI, for example, Goldman Sachs commodity index. You don't go to exchange to buy crude oil contract or something. You just make your trade through swap dealer in over-the-counter market. You just say, okay, you want to have 20 commodities, and then Goldman Sachs as the swap dealer can perform that task for you. So that's why I said swap dealer serve two purposes. One for commercial, the other one for commodity index trader. This is, you can call it, these are speculators actually. But I don't think so, because they don't have any, they don't care about the price movement. What they do care portfolio diversification or to hedge against inflation. They don't really have any prediction about the futures. So it is different than speculation. But still, some people believe that these are, they don't need crude oil. They don't use crude oil. They are not producer, they are not manufacturer, they are not consumer, airline. They just want to have some open position. Last but not stylized fact, investor interest in commodities except precious metal still continues up until 2013. Precious metal decline after that. Okay, and then one last thing is correlation between asset classes during, especially after 2008 Lehman demise, increased a lot. So some argue that, okay, diversification benefits, so why are you investing there? Then you need commodities at most during the volatile period. They are acting like stock markets. They are acting like bond markets. They're all risk on or risk off. So the benefit of financialization is in question. If you have much more activity by MMPs and everything, if they are causing this cross-market correlation, then we have to say, okay, we understand there are some benefits of financialization, but if this causing portfolio diversification benefit declining, so we have to see welfare consequences of financialization. So the first question is, I'm going to say, can fundamentals explain this prices? I'm going to say yes on that one. Look at this China share of global consumption of base metal, comparing 2000 versus 2012. China was consuming base metal, this one, only 10% of base metal, as opposed to 40% in 2012. In aluminum, for example, it increased to 60% of world production is consumed by China. Chinese oil consumption increased from 3 to 4 million to now 13 million barrels, while OECD countries are generally decline or flat after 2005. That's why we have fiasco of IEA. When IEA cut the demand growth in 2006-2007 period by 2 million, everybody was shocked. I mean, they didn't realize how Chinese growth was very strong. Anyway, I'm going to come to that point. Look at this. Here is the real WTI prices, and United States, the line shows cumulative marginal oil demand since 2002. Real WTI prices as if they are moving very close to marginal demand coming from China. Total China consumer, basically very good illustration can explain price movements. Basically, we have the surging demand from China and other emerging market economies, and stagnant production up until 2010. Shale oil production came after 2010. There was not much. And the spare capacity declined to 2.3 million barrels, almost 80% Saudi Arabia. There was not much spare capacity also. And then the question is, there's a lot of increase in inventories, there's not much also. And then you can ask, oh, speculation can cause price increase without inventory buildup. That's correct. I'm not going to say, oh, it's not possible. Price elasticity demand is zero. But studies suggest price elasticity was never zero. It was about 0.1 to 0.13. So it's not possible without inventory buildup, speculator causing the price to surge. Okay. Basically, there are lots of VAR analysis of speculator role in commodity markets, suggesting that actually existing evidence is not supportive of important role of speculation in driving the spot oil price after 2003. This is true for 2008 price. Okay, I'm not talking about what happened after 2011 or something. There are some studies finding some role for speculation. What I'm talking about 2009. So the question is, is there any role for financialization causing the price to deviate from fundamentals, even in the short run? So let me first discuss with you that financialization of oil markets become a key driver of oil prices. For this, I'm going to define financialization as an increasing exposure to commodities by a wide set of market participants, such as hedge funds, pension funds, and insurance companies, retail investors. Some people argue that financialization has become relevant with the rapid growth of commodity index investment around 2004. Others see emergence of hedge funds, index funds, electronic trading, and exchange traded funds and exchange traded notes as part of the process. Therefore, the starting point goes back to 2002 rather than 2004. Let's look at some, what are the instruments, who are the players in these markets. Basically, if we define derivatives, derivatives are financial instruments whose returns are derived from those of another financial instrument. In this case, for example, crude oil futures, you need to, there is the, it depend on the crude oil physical markets, cash market versus spot market. The sale is made in the cash market. payment is remitted and good or security is delivered immediately or shortly thereafter. Basically, it's completely different in futures markets. Derivatives market also, basically, let me say, in oil market, you don't see much spot trading. Many of them are long-term contract, and then you can maybe 15% or something. You can talk about 10 to 15% spot trading, but remaining it's always long-term contract. For example, Saudi Arabia says, okay, I'm going to deliver you 1 million barrel next 5 years at a price A plus epsilon. Epsilon is the let's call whether Saudi Arabian oil is better quality than reference price. Reference price is A, which is, you have to agree on that one. Maybe you can say A is equal to Brent price at the time of delivery. So this is the, you always do the contract term over there. But there is no immediate delivery over there. Derivatives markets, on the other hand, they are contractual instruments whose performance depends on the performance of another instrument, so-called underlying. Here, I have the what's called crude oil futures contract for next 10 years. First 5 years, every month, every December and June. So you can buy 10-year contract. There is no, is there a delivery? Not generally, because less than 0.5% of derivatives contracts are literally delivered. Mostly, they are, let's call, before it matures, you buy an opposing contract. If you buy a buy contract and then you sell it, then you don't have any obligation. So, why? Way the derivatives are used to hedge risk, especially by commercial traders. These are producers, airline companies, manufacturers, refiners, all this stuff. And then to speculate, of course. Take a view on the future. This is what hedge funds are doing. If you believe price is going to be higher, given the information yet set you have, you go long on the market. If you believe prices are going to go down, then you go short. It is better to use all the available information, because if you make mistake in your prediction, you lose money. If you are correct in your prediction, you gain money, and also you stabilize the markets. Just think about, you have a car. You fill your trunk always. I'm assuming prices are free market. It's not state controlled or something. Price going up and down, demand and supply. You 2 or 3 days later, price is going to go up. What is your first thing to do? First thing, you go to what's called gas station and then fill up your tank so that you increase the demand today, pushing up the prices. But in 3 days' time, demand is going to be lower. That pushes down the prices. So it is somehow stabilizing the prices. Volatility is declining, while there's not much long-term impact on prices. So, of course, to lock in arbitrage profit, this is not exactly in commodity markets, but this is also true for Forex market, for example, arbitrage opportunities, or the financial. To change the nature of liability, you might have a fixed interest and then you want to take adjustable rate of interest, that's fine. Or to change the nature of investment without incurring the cost of selling one portfolio or buying another. Here, there are two ways to do. There is exchange-traded instruments. Basically, they are standardized in terms of maturity, in terms of notional value and settlement procedures. This is crude oil or natural gas. WTI is one example. And or you don't have much counterparty risk because you are margining. And then the over-the-counter product, it's not standardized. You just make a telephone call. Okay, you want, because sometimes it's not traded on exchange. Just think about jet fuel. It's not traded on New York. So you have to go through swap dealers to make the arrangements. Basically, these are not standardized, as I said. Private transaction between two parties, but now rules are changing. It has to go through the swap execution facility rather than making a telephone call. But at that time, we had the over-the-counter markets. Basically, there was no margining, there was nothing. There was the trust between buyer and seller. Okay, but if you look at the size of the market, over-the-counter market was much, much higher than exchange-traded market. Basically, but most of them are interest rates and then Forex swaps. But still, at the height of 2008, we had about $673 trillion over-the-counter notional value, of which $400 trillion interest rate derivatives or swaps, and then $12 trillion commodity swaps. So it is still high. So what are the products? We have the forwards. It is the over-the-counter, and then futures, exchange listed, and then swaps, and then options, both OTC and exchange listed. Which are the what's called three instruments crude oil market uses? Generally, most used is the options, and then the swaps, and then the futures. For example, if you look at Mexican government, which hedges 100% of their crude oil production, they use generally swaps and also options also. So we define derivative as an instrument whose value depends on the values of other more basic underlying variables. For example, forward and futures, it's an agreement, it's a contract to buy and sell an asset at a certain future price for a certain future time for a certain price. Basically, this is the obligation. Once you sign the contract, you have to buy or sell the contract. If you don't, especially forward, you have to do that. In the futures, if you don't want to do that, you need to buy an opposite. If you are long in crude oil, you need to go short before its maturity to release your contractual obligation. And then there's the call option. It is a right. It's not the obligation. Underlying asset by a certain date for a certain price. Put option, on the other hand, it gives the holder the right to sell the underlying asset by a certain date for a certain price. This is still right. If you don't want to exercise, all you lose is your option premium. And then the swaps, of course. They are agreements between two companies to exchange cash flow in the future according to prearranged formula. This you can think of series of forwards contract. Basically, it is the obligation, but instead of one forward, it is, let's say, every 3 months I want 1 million barrel crude oil. Then every 3 months you are going to get crude oil, and then the other party is going to get the money. fixed price. So in this market, we have several different types of traders. First is the hedgers. Hedgers, the main purpose of hedgers is to eliminate risk. I don't care. I want to eliminate risk. Let's say that if you look at prices, future price, for example, in 1 year, that is not the expectation of spot price in 1 year. It is the price at which you are willing to hedge. Future prices literally cannot be used as a good predictor of future spot prices. Our econometric studies suggest that beyond 6 months, they are worthless. You use today's price as a good price is much better than the future prices. So I don't suggest you to use future prices as a prediction. It is just the price at which you are willing to hedge. That's it. That is the thing. And then, of course, speculators to make money on market expectation because you have a view on the price of market. And then arbitrageur, of course, to make money on market imperfections. So, but I'm not going to talk about on that one because there is not much arbitrageur in crude oil futures markets. Mainly hedgers and speculators. Who are the hedgers? Producers, manufacturers, wholesale dealers, refiners in the manufacturing. Who are the speculators? Hedge funds, floor broker and traders. You can call also commodity index traders. These are the, basically, there are two main functions of futures market. One is price discovery, if there is enough information and enough traders. And the second one is transfer of risk. As long as we have enough liquidity, then derivatives markets can perform these two functions very well. Okay, let's look at now physical and financial market linkages. Okay, we have we have a lot of financial players. They are playing in the derivatives market, but they are not just getting ideas from nowhere. They are looking at the physical markets, what's happening in the physical markets. We have to see this speculator facilitate the needs of hedgers by mitigating the price risk. Basically, you are taking the, as a speculator, you are taking the price risk because you don't know. You have an expectation, but you don't know what's going to happen. Then hedgers need to pay some premium to you. In some cases, but speculators do not only serve hedgers, they do trade with each other. That's why there's always much higher speculation than the market needs. That's why they call it excessive speculation. But excessive speculation doesn't mean a bad thing, actually. Because sometimes in terms of maturity, in terms of grade, you don't know the other party. So it's higher and higher trading so that everybody can find counterparty. So because long and short hedgers do not always trade simultaneously or in the same quantity, speculator must step in to fill the unmet hedging. If you look at the, for example, speculative index developed by Working, it increased to 1.4 from 1.1 in 2001. It means that 40% higher than minimum required. But this is, if you look at other markets also, it's very reasonable. There's not much excessive in terms of much, much higher speculation. So this is problematic also because this suggests that might have contributed to price increase during 2008. Of course, my research plus some other research suggests that speculative activity in crude oil futures market did not lead to price change, but reduced volatility by enhancing market liquidity. On the other hand, some others find impact of investment flows by non-user participants, especially commodity index traders, on price and volatility and commodities. Singleton, 2011, suggests that, okay, or Vision, for example, their argument that, okay, now you increase your demand, it might be signaling producers different price setting. Your decision to invest right now, it might be impacting the physical markets. Okay, I'm going to say, for example, Singleton 2011 looked at the still causality, but he looked at period between 2001 to 2010, 13 weeks difference, not 12 weeks, not 14 weeks price differential, or not 6 weeks. That is the only time you can get statistically significant impact of commodity index traders. And if you extend the period to 2012, the impact disappears. It just reminds me, Salah Martin paper, I ran 1 million regression, but I presented only one. That is the one. That is the one that proves my points, the speculation effect. That's not the way to go. Yes, speculation can affect, but just to sake of, to prove it, choosing some arbitrary number for some arbitrary time frame, it is not an academic research at all. I'm not saying that speculation never affects. It does. But during 2008, we tried almost daily data, weekly data, monthly data. We extended the time period all the way. We didn't find anything. But anyway, in terms of cross-market linkages, but both sides, or my side and Sohbet side, are agree that these traders, speculators, or commodity to link these two different markets together, move together. Okay. Here's basically, as I said, price discovery generally takes place in derivatives markets, which themselves use perception on current physical demand and supply condition, as well as expectation of future condition. But the thing is, as I said, the data coming from physical market is not good quality data. For example, just think about last month, IEA, International Energy Agency, oil market report. They reduced the demand very limited. I mean, everybody knew what's called demand is going to be affected really, really high, but they didn't reduce. The data available for them suggested only to reduce, in the base case, only 300 kBD. I mean, demand growth is going down 300 kBD. This month, with much more data, they are suggesting 29 million decline in demands compared to last April. If I have the data, of course, physical data tells me everything I need to know, but data comes at a later stage. Just think about Canada. You are going to say, oh my God, Canada is a great statistical, collection agency, has a collection agency. No, it's not true. We revise, I was in the Bank of Canada, we revise Canadian production number almost 2 years after it first comes. That's why perfect data. I mean, it is a perfect, but we don't have the timely and reliable data coming from physical markets. We base our decision or expectation based on data available. When the data changes, we change our expectation. That's why sometimes if this expectation, if these data are wrong, then speculator and other traders can make mistakes and also can move the markets. But that is very short term. Anyway, as I said, but the thing is, through inventory, physical markets and financial market basically is in sync. So we always, for example, whenever I do my econometric studies, instead of using spot markets, spot prices, I can use nearby future contract, nearby, okay, just nearby as a proxy for the spot. But beyond that, I don't use it at all. Okay. Basically, that's why I say empirical studies generally show no causal linkages from speculative future market position to prices. However, lack of information about OTC market, that was a problem at that time. We were using only exchange traded products. We didn't have any swaps data. Okay, that's why there is an increase for both physical and financial marketplace. I just say hedgers, but just think about what you call hedgers. Let's say that producer or refiners, or when they hedge, actually, they are making some kind of speculation. Although they're hedging, I know, but the main purpose of that, they have some idea of where price is going. We cannot say, okay, they don't really value and speculate. That's why it's difficult to pin down the role of speculator, just looking at the speculator position. But it is the only available data we have. All right. Okay, let's look at the potential benefits and cost of financialization. Of course, there are positive consequences of financialization. Might include more efficient derivative pricing methods through linking future prices at different maturity. Because we look at, for example, in my research, we look at how up until 2004, one-year contract versus 2-year contract, they were acting as if these three contracts are different commodities or different markets. There was no relationship at all because there was not much trade early in 1990s on 1-year contract and 2-year contract. There were only very few hedgers, producer or manufacturer. Then they were not trading much. There's not much liquidity. The prices are going all around. But when the commodity index trader plus speculative hedge fund came, they provide much more liquidity. These markets, 1-year contract, 2-year contract, and nearby contract started to move together. This way, it provided much more reliable hedging opportunities for different traders. Of course, financialization helped physical crude market become more integrated by reducing transaction costs and facilitate arbitrage across geographically distant markets, across crude oil of different quality. This is Fatu argument. And then reducing the market price of risk with stabilizing effect on oil prices. This is wrong, and I'm going to talk about that one. But potential negative consequences of financialization may include its impact on prices, its impact on volatility, and its impact on portfolio diversification. So I am going to talk now potential negative consequences of financialization. If it is positive, let's leave it there, because we really don't mind having the positive side. How about negative side? Do we really have these can we quantify the impact of these negative costs? So I can compare with the benefits, and then if the benefit is higher than the cost, then I can say financialization is a good thing for commodity markets or oil markets. If the cost is much, much higher than benefits, then I need to regulate. I need to regulate in terms of position limit. I need to regulate in terms of how much they're going to, let's call, be interacting with physical markets. So the question is financialization destabilizing? Barish, how am I doing in terms of time? Sorry.
No, well, well, I think it's fine. There's no problem in that one. If you want, we can give a 5-minute break and then we can come back and continue from there. If you want, maybe let's give a 5-minute break.
That's fine, okay. Because I still have about 1 hour slide. So
okay, you know, we can give another 1 hour to Sohbet. So in 3 hours we will wrap up everything. But during the break, I think close your camera and check for background programs, okay? Because I think one background program, Bahattin hocam, in your computer is causing some jittering every like 10 minutes or so, isn't it? Sohbet Bey, isn't it?
I'll close it.
Okay.
Okay.
It causes a delay or jitter, some kind of jitter at the background. Just check for it. Then we are giving a 5-minute break. After that, you start straightforward, okay?
Okay.
5-minute break.
All right.
All right, I'm closing the camera. Arkadaşlar 5 dakika ara verdik ama yayındayız. O yüzden bence siz de kameraları açmayın. YouTube yayını şu anda devam ediyor. Bir yaklaşık 5 dakika aradan sonra Bahattin Hoca ile devam edecek bu iş. I think in the first part, if you have seen, Professor Büyükşahin has talked about the financial products, whether they have any effect on kind of financial products. So we, in the first part, we see that there is an interaction. There's some kind of interaction, but there are different modes of interactions. I think that was the main message. And if you think why they are using for these products is for price discovery. They are not good indicators of future prices, although they provide hedges. They using these products for beyond 6 months it may not be good. On the other hand, you cannot say in a straightforward way that speculation caused all this. Let's listen to the second part. Yes, Professor Büyükşahin.
All right. Now, the question is, as I said, there are benefits and there are costs to financialization. I'm going to talk about the costs part now. Is financialization destabilizing? As can be categorized in divergence of prices from fundamentals, excessive volatility, or erosion of long-run diversification benefits. Do we see this in the data? Divergence of prices from fundamentals, or excessive volatility, or erosion of long-run diversification benefits. Here, if you look at volatility, basically, as I said, price of oil, like those for many other commodities, are inherently volatile, and volatility itself varies over time. It is here in this market, the red line showing volatility Garch 1-1, showing that in 2008, volatility spiked. However, beyond 2009, it returned to historical level. So the volatility of oil price during 2008, 2009 raises question about the determinants of volatility in oil markets. Some argue that this is the result of financial players. Others argue that no, financial players also reacting to the same fundamentals with the physical market traders. Question is simple question. Is speculative activity destabilizing the markets or moving prices? We have the stabilizing speculation theory from Friedman or Keynes or Hirschleifer. Profitable speculation must involve buying when the price is low and selling when the price is high. When they do that, they actually provide some stabilization. And the speculative hedgers demand and supply imbalances and provide reducing the volatility. This is the Keynes argument. Of course, we have some arguments against this one, destabilizing speculation. Schleifer and Summers argue that herding, basically mimicking behavior. For example, if you believe Goldman Sachs has more information than any other, then you just follow footsteps of Goldman Sachs. You don't need to look at what others doing or what the information you have telling you. This is mimicking behavior. And this can result from investor reacting to the common signals or overreacting to recent news. Long et al. Suggest that rational speculative trading via positive feedback strategies can increase volatility and destabilize prices. So we are going to look at first whether we see some feedback from position to prices and then whether there are herdings in the crude oil futures markets. Role of financial players first. The thing is, more investment money in commodity futures markets. Thousands of hedge funds and commodity index funds. For example, assets under management exceeded $400 billion in 2011. Inflows of $350 billion in 10 years. This is just the commodity index traders. This is a huge amount. The question is, what could this development mean for energy price level, oil market volatility, and cross-market linkages? This is OPEC and some others argue that oil speculative activity, perfect correlation, strong correlation between net hedge funds position and crude oil prices. But there's a problem with this one. Prices, okay. Hedge funds net position is just that they include all maturities rather than only front month contract. What we did here for each category, we consider level of net future position, change in net future position, and level of net total position. This includes option also. Change in net total position also. When you include our assessment versus net futures and option position, also you can see some positive relation. However, if you look only net future position nearby contract, which refers to the settlement price, the correlation is really disappears. We run some multivariate Granger causality tests. We found that returns are not Granger caused by position, including those of swap dealers and hedge funds. Hedge fund activity does not cause any variable in the system, including the prices. It's caused by all the variables in the system, including prices plus the fundamentals value, reacts to market conditions and provides, and they reduce the volatility. This paper we published at JFQA last year, and swap deal activity generally reduces the volatility, just providing liquidity, but they don't have any information, bringing information over there. In terms of contemporaneous effects, hedge funds are reacting to market conditions and providing liquidity to the market. There is a unidirectional causation from change in price to change in money, managed money trader position. Interestingly, swap dealers' change in position is preceded by change in prices. Basically, swap dealers' position might be impacting, but the statistical significance is very low. More transparent information on composition of open interest, just looking at maturity, you cannot get any information on that one. That's why in-house data is much more detailed and disaggregated. We suggested at that time to CFTC that they need to provide much more disaggregated data to the public so that much more research to be done. Okay, this is my favorite comics. Correlation does not imply causation. And then I will send you the PowerPoint slides through Barish. You can see that this one is really nice. I wish they didn't turn on that seatbelt sign so much. Every time they do, it gets bumpy. That is exactly what's happening. We see the correlation, but the causation might be completely different. Or these prices and to the common factors, like China demand growth, price is increasing, and also they see that one price is going to increase. Money market or hedge fund, they are increasing their position also. There is strong positive correlation between net hedge fund position and crude oil prices, no impact from prices to hedge funds, from hedge fund position to prices, but the impact is from prices to hedge fund position. So, but you have to look at, okay, let's say that we have the exchange traded commodity, so-called crude oil. How about non-exchange traded? Basically, there's not much speculator over there. There are no hedge funds. There's no commodity index trader. Did they react or did they move like crude oil prices in between 2003 and 2008 or 2009? When we look at these data and comparison of non-exchange traded commodity price index, supports the notion that starting 2003 and more strongly after 2004, a demand shock pushed upward the price of most commodities. Look at cadmium or rhodium or cobalt. The highest to lowest price increase between 2000 and 2010 period suggests that the price increase in these commodities much higher than price increase in crude oil, where in these three commodities we didn't have any speculators. Commodity prices here declined sharply after the economic contraction following the Lehman demise, and then they recovered later on. But what we see over the crude oil prices declined much more than other commodities, actually. This might be some kind of overshooting in the markets. As we said, non-exchange traded commodity index volatility experienced large spike in early 2007, while crude oil prices were still relatively stable. And unusually high volatility in commodity markets post-2007 does not appear to unique to crude oil traded on exchanges. Non-exchange traded also experienced the same kind of volatility spike and also price spike. This is not to say also trading of future and derivatives contract on exchanges has no impact on volatility. All we are saying, we need much more data and research on the markets condition. How about herding and speculation in crude oil markets? We said basically herding or mimicking behavior can cause destabilizing in the market and also cause prices to move away from fundamentals level. Basically, herding in futures market is comparable to what we see in the stock markets. It's about 57% or something. Basically, some traders really doing the same thing some of the competitors does. But in what we found, herding has stabilizing effects. I'll come to that one. Talking the prevalence, sources, and effects of herding. Basically, we try to test the herding by assessing the degree of correlation across hedge funds in 32 markets. We test for positive feedback trading by whether their past trading affecting the current trading, past performance of future. Finally, we test for excess demand and price changes. What we find, overall herding measures for nearby contracts 0.07, basically 57 for hedge fund, and 0.046 for floor broker and traders, and no indication of positive feedback trading by hedge funds. They are not making their decision based on the past performance. That is the important thing. When prices are falling, 20 out of 32 markets, hedge funds may be herding. Buying implies a stabilizing effect. Basically, when prices are falling, they are buying. It means they're providing much more demand than stabilizing the prices. Of course, why do firms or individual herds? Large traders might have greater incentive to herd due to perception that other agents might have superior information. As I said, you might think Goldman Sachs might have the best information. You just follow their trading exercise rather than using your own information, because your performance might be tested against Goldman Sachs performance. So reaction, it might be the reaction to the same exogenous shock. Basically, if you all believe that China is the shock, then they should be used, they are facing the same shock, so they should be doing the same trading arrangement. What we did, we had herding between hedge funds and floor broker and traders. These are the main non-commercial traders. Positive feedback trading across the groups. The question is, does herding occur among hedge funds? If so, does trading partner have a stabilization or destabilizing effect on market prices? And the same thing is for floor brokers. Here, this is the overall herding for hedge funds and floor brokers. And of course, red line, FPTs, and blue, kind of blue, hedge funds. We are seeing the herding value, especially in crude oil, it's about 0.5 versus 0.10. So what we conclude here, larger levels of herding for hedge funds than for FPTs, but both groups have significant levels of herding. Our to roll and non-roll periods, and indicates that similar trading strategies add to the overall level of herding, and support the notion that information takes away incentives to herd, with contrarian trading based on limited access to information driving much of the herding in futures market. But we conclude from here, the number of traders and floor boys market are positively associated with herding. Trading volume and electronic trading are negatively related, and the significant levels of herding by hedge funds serve to stabilize rather than destabilize prices in futures market. But one argument, we have to be very careful with herding. If they increase the herding much more, and if they destabilize the market, there is a big problem. So regulators need to be very careful in terms of mimicking behavior among different traders. So that's why sometimes it is better to control some of the mimicking trading behavior over here. And then, of course, we said stabilizing speculation, but we find demand shock pushed upward the price of most commodities. These are the general conclusion. High volatility in commodity market post-2000 does not appear unique to commodities traded on exchanges. Non-exchange commodities like cadmium, some other obscure commodity display the same kind of volatility and price spikes. Price discovery generally takes place in derivatives market. Market looks for information in physical market, don't forget that one. If future prices increase, spot price must rise through inventory arbitrage. We know that one. Low price elasticity of demand means small change in demand or supply can produce big change in prices. Herding behavior might cause destabilizing effects, You have to be careful on this one. So it's always desirable to monitor the herding behavior among large traders. So the last cost of financialization is the cross-market correlation. This is an interesting area where the thing is, okay, if cross-market correlation increases, portfolio diversification benefit declines, but so what? What other costs? Welfare consequences. So increasing correlation between commodities and other assets due to financialization. What we see, for example, activities of financial players, commodity prices and asset prices appear to increasingly responding to global business cycles. This is okay. But the thing is, temporary prevalence of common factors, the risk common factor. The thing is, especially after 2008 Lehman demise, all the markets start moving together. This has a bigger implication. Here, I'm looking at GSCI, Goldman Sachs Commodity Index, and then Dow Jones UBS Index, DJIA, US Equity Market, S&P 500, MSCI World Equity. We see commodity and equity market were not in sync. Beyond it start to move together, especially if you look at the return correlation, but not the price level. This is after the Lehman collapse and Egypt protests. We see very high correlation increased to 0.6 or something at the highest. Before that, correlation is just fluctuating around 0. That's a good thing for portfolio diversification benefits. But when you need the different asset classes in a rainy time, umbrella breaks. So it is just amazing. Everything is moving together. Here is the thing. And of course, when you rolling versus DCC dynamic condition correlation will take into account volatility changes as opposed to rolling correlation. It doesn't take into account, then this might lead into wrong conclusion that the correlation start increasing in 2004 or something. But we find that correlation start increasing after the Lehman demise. Basically, overall speculation is up from about 10% excess speculation till 2002 to 35 to 50% after 2005. Commodity trade index trading is up. Swap dealer position account for about 35% of futures open interest. Hedge funds position up from 5 to 10% of futures open interest till 2002 to 25 to 30% after 2005. And then cross-market trading is up, tripled since 2002. Patterns does not follow the other working key index, as I was talking about. This is the speculation. It was supposed to 10%. It was 10% in 2000. Now in 2008, 40%. This is overall versus near dated swap deal position, because as I said, swap deal position, near dated contract can be a proxy for commodity index trading. Overall, on the other hand, it might be a proxy for their commercial services. This is hedge funds share of energy futures open interest. As you see, it increased from 0.5%, so 5% to 35%. And the thing is, hedge funds cross market, both energy and equity futures. These are the traders that are linking equities and commodities, and then market. I'm just asking whether these traders, those who are trading both in energy and equity futures, are they linking these two different markets? What we find, I mean, the thing is, should trader identity matters for asset pricing? Here it suggests yes, identity suggests trader identity matters, because model showed that less constrained traders link asset market. During financial stress period, contagion impact. Basically, who are the candidates for enhancing linkages? Basically, less constrained traders. They are the hedge funds. And traditional commodity users, I don't think so, because they don't have much liquidity. They provide liquidity, of course. Hedge funds, yes, they seek to have all the information of course, they seek to exploit perceived misinformation, mispricing, and they are levered, subject to borrowing limits, wealth effects, but they are more likely to be less constrained, so they are more likely to link asset markets. But we find time variation and correlation, but no upward trend till Lehman demise. Extreme event analysis shows commodity umbrella leaks when it is raining. Speculation in cross-section of energy paper markets, increase in speculation and hedge fund activity and cross-market activity. But impact of hedge fund in energy market, hedge fund activity helps links market stress matters too, and interaction, contagion, and information why composition is payoff relevant. As I said, we need much more information. What are the conclusions? Activities of financial players, commodity prices, and other asset prices appear to be increasingly responding to unexpected global business conditions during 2003 to 2009 periods. There are benefits and costs to financialization, and welfare consequences of financialization depend on whether benefits exceed costs. We need further studies, especially on the cross-market linkages, whether the cost of reduction in portfolio diversification exceeds the benefits of hedging, let's call benefits. And economic fundamentals, in particular demand factors, matter most in oil markets. And one other thing, in terms of oil price forecasting, don't rely on future prices beyond 6 months or something. It's better to use current prices because it embodies all the relevant information for future prices. So I want to thank here and then leave it to Barış and Sohbet, and we'll listen Sohbet's presentation.
Professor Büyükşahin, excellent presentation, and you have given us lots of ideas, especially this herding thing. I haven't heard of it, and about the details, I think we have talked about it. But now we are inviting your arch enemy, Dr. Sohbet Karbuz.
And now, thank you so much.
Come on, we are not enemies at all. He's a very good friend.
Okay, Dr. Karbuz, the floor is yours.
Well, actually, it was really excellent. I benefited a lot from Bahattin's presentation. The only critic or comment I have is that I wish it could last a bit longer. Maybe in the question and answers time, if we have, I don't know. There are some areas that could be developed, and I would love to hear Bahattin's remarks on that. I will cut it short because Bahattin already mentioned many of the things that I will show. Now, if I can switch to presentation. Do you hear me?
I can hear you. I cannot see your presentation, but after you end the presentation, we will have a 10-minute chat about the oil market from now on, okay? I would like to hear your ideas, and I think our YouTube viewers would like to hear your ideas about where from now. Okay, we are waiting for your presentation. Do
you see it?
We see it, well, okay.
All right. Now, first of all, we don't know who sets the prices. We cannot know because nobody sets the prices. The market decides. And according to Naimi, Allah knows only. So that we leave aside. Now let's start. I should go. How do I go? Sorry for that. Now, supply demand, we know if they are equal, there's no problem. But most of the time, supply does not equal demand. And there are, especially, I'm talking now about oil market. So they usually always have some small discrepancy. Sometimes this discrepancy, what we call inventory changes, can be big. But the economic theory, this is basic economy theory, as we all know, if demand increases and supply is not changed, price should increase. And there are some other combinations that you see. If demand doesn't change, stable or flat, but supply increase, the prices go down. And there are, as Bahattin mentioned, there are many factors in oil market. We have supply, demand, can be broken both OECD, non-OECD, and OPEC, non-OPEC. And we have financial markets. There are many other issues. It is not only, of course, financial markets. Then we have economic inputs like interest rates. By the way, in my view, interest rates have been extremely important in the past decades in oil prices increases. When you plot them, you will see that interest rates sometimes were leading oil price increases. And then we have, of course, geopolitics, we have weather components. There are plenty of everything. But our subject is 2008. I mean, I will talk only about 2008. And in 2008, the perception was that speculators were to be blamed. And there were some others who were saying that whoever says that traders are behind the oil prices, they are paranoid. And, normally there were two schools. One is oil price changes were completely because of the dynamics of supply and demand, which is backed by the IEA or Energy Information Administration. And then the second school backed or promoted mostly by OPEC and some other people, that speculators to be blamed in 2008 oil price changes. Now, as Bahattin showed, we have two markets actually, one physical market and one financial market. And in those markets, we can separate the players into two parts, hedgers and speculators. Now, the issue is that I do not think that the distinction is that clear, because at times there were, for example, banks who were doing, who were actively playing in the financial markets, but they were also active in physical markets. If they were buying and selling, storing. So I think the distinction today, especially today, is not that clear. So it is all mixed up. Now, when we call financialization, we think of increasing role of financial investors. So they have financial motives. They want to make money. That is it. Now, oil futures are very liquid, okay, but again, when we are talking about two more markets. One is physical market, and the other is paper barrel market. Physical market is usually called wet barrel market, and paper market is the futures market. or derivatives market. Now, in physical market, we have limited supply. There is limited supply, limited demand. You know, it cannot go up infinite. But in futures market, the supply is unlimited. As long as the people are willing to bet, to pay, to speculate or to move prices, to make money. So it can go up and up. There is no limit. Now, when we look at here, WTI price, it was huge. Why? This is why. Even in historical level, it was a splendid increase and decrease in 1 year time. And now let's focus only on 2008. 2nd of January 2008, the price was more or less, this is Brent, by the way. The Brent price was nearly $100. 11th of July, close to $150. So we have 50% increase. And then when we came to the end of the year, 31st of December, we are $50. You see this dramatic change. Now, in the first part, we had a strong demand and not very much increasing supply. So we can call stagnant supply. And commodity super cycle, when you look at the commodity prices around that area, they were increasing as well. And in the second part, we have the effect of global financial crisis and a demand shock. So it sounds okay and acceptable. But in 1 year time, when things cannot change that much or did not change that much, it is true. Economic growth went down. Here we are today is much more than that, but this is not our subject. You see, the demand shock was visible. So, but on the other hand, when this price increased in the first half, demand of whom, demand of what? These are two important questions that should be asked. In fact, this the main driver, one of the main drivers of this demand increase was the diesel, increasing diesel demand and storing of diesel before the Olympics in China. So Chinese demand and in general, diesel demand in particular. And in the second half of 2018, we have the recession and we have the collapse of Lehman Brothers and Saudi Arabia relaxing output after May. But this financial aspect of collapsing of Lehman Brothers was very important. Why? It caused a panic. And this is the similar panic we observed this year in March. But before March, even when the financial market started to panic, what happened is that it was widespread. It impacted oil as well. So the people had margin calls. So they had to close positions, and then we've seen that this massive sell-off in equities and oil simply moved to gold, but even that was not enough because the panic situation was widening. Margin calls, everybody was getting margin calls. They even got out of gold market, and it took some time. And then we had the Fed increase, reducing the the interest rates and pumping the dollars, and it started to move up again. Now, so what we have today is not too much different what we observed in the second half of 2018. Now, Bahattin showed similar thing. Yes, volatility was very high at that time. And today it is much bigger than that. But in the past, more than two decades, you know, this is the area where we had the highest volatility in the market. I see that some animations didn't come out, but anyway. Now, I show you something what IEA said in 2010. It said, debate on the precise degree of price impact derived from speculation is inconclusive. This is based on the workshop that IEA organized in 2010 to discuss the role of speculation. So inconclusive. So the speculators are not the main culprit, maybe, but we cannot say also the same thing for supply and demand, because Bahattin mentioned we do not have good data in oil market. Well, I didn't have the monthly oil data of the IEA, and you need time series, but whoever has access, I will give you a homework. It would be, and I would be very much interested to see a chart, the following chart. Get the IEA's oil market reports from January 2018 and 2019, or I mean the monthly data service at that time. Plot supply and demand, and take the latest 2020 IEA's monthly oil data service data for supply and demand. We're talking about world supply and demand, and put the numbers, revised numbers for 2008 from January to December, and see or compare the current with the current knowledge, the real, what we perceive, the real supply and demand data is for 2008 with the numbers we had in 2009 or 2010 even. You will see big differences. They're not the same data. So we have a pathetic situation of market data. And we have an old data. Prices are moving day by day. But the closest reasonable data we can have, especially for monthly data, is at least 2 years back. You know, prices are moving today is based on estimations, what we can call maybe guesstimations, because we don't have real monthly production data that reflects with even 80% certainty the real supply demand situation in the world. No. And on top of that, this is the frequency that we have, mostly monthly data. And those monthly data is available mostly for OECD countries. For many non-OECD countries, you cannot have regular monthly data. This is impossible. But prices are moving day by day, I said again. The high frequency data that we have is Energy Information Administration. This weekly data, we have weekly stock data, weekly supply demand data, but they are just estimates. They are not collected data. This is so. Then we cannot say, and also I do not agree that to look at causality with open positions of financial investors and then say that, well, we don't have a correlation, they do not have any impact on physical market. So I'll give you an example. At that time, they were giving the same similar example. Think of a poker table, and you have a pot. The pot is increasing. What causes the increase? The cards that the cards lead the the cards are the cause of the increasing pots, or the players. You know, normally the players change the cards because they think that they will get better cards, and they increase their bet. They change cards because they think that they follow what the others may get. They know more or less what is happening, so they change their perceptions. They increase. So who's to blame? The cards or the players? So this is maybe too different from the discussions that we have on oil market speculation versus fundamentals. So that is what I'm saying, is that in the second half of 2008, the prices collapsed from $150 to $50, despite that we had an explosion and fire in Canada, despite unusual large amount of drop in US crude inventories, and we had more than 400,000 barrels per day shut in Abu Dhabi, and we had OPEC cuts twice in that 6 months. So, but the prices are going down, and you think that demand collapse as it is today? No, it was not. So one more example. I will now focus on two periods. One is August, the month August, and the other is September, from the September till 23rd of October. Now let's focus the first one. What happened in this area? In 8th of August, sorry, this is Turkish. We had a war, Georgia and Russia, and we had a disruption in Baku-Tbilisi-Ceyhan pipeline. So the flow was 900,000 barrels per day. It stopped. Then we have a disruption in Baku-Sipsa pipeline. Then we had a hurricane, Gustav, in Mexico. It shut in 1 million barrels per day production. And we had also terrorist attacks in Nigeria, and 1 million barrels per day of supply or production was cut, and the prices moved only little. So does this make sense? If only production and consumption, or better said, supply and demand to blame? You can have many negative things for production, and we are not depressing oil prices. But when we look at in October, what we have here we have market dominance. Why? Lehman Brothers bankrupt, Merrill Lynch sold. And when you say that, and I can hear that, well, despite that, why the prices went up? The prices went up because September contract expired. So the people covered their positions. And then on 24 October, here, OPEC decided to cut production 1.5 million barrels per day. At the same time, US gasoline stocks were lowest since 1967, and so, but when such a big thing happened, you see the price didn't move much, but collapse of Lehman Brothers, you see the impact from $113, it went all the way down to $57, nearly halved. And you think that in 1 month, supply demand moved so much? No, this doesn't explain, because as was the case in around 6th of March, market participants were liquidating as many positions as possible to pay the margin calls. That is it. So if that is not speculation, I don't know what we can call speculation. Now, this, of course, just looking at the charts. We are not doing any statistical analysis. There are some statistical analysis, but to focus only on 1 year, you need high frequency data. This positions of all players may be broken down by hedgers and speculators, including not only WTI and Brent, but all the markets where we had physical and derivative trading. But if possible, in daily basis or hourly basis, this is high frequency data. We cannot look at monthly data and, here 1 month. We cannot make any statistical analysis for this 1 month. If we had data for hourly data, yes, we could. Well, we have hourly price data, but the issue is that can we have hourly this financial data to make any kind of econometric analysis? But there are some econometric analysis that cover wider time horizons. And again, Bahattin mentioned a little bit about this too. It is not very conclusive. You cannot say that futures prices cause or leading spot prices, or spot prices are causing futures prices, or there is a bilateral. But the majority shows that futures prices are information dominant in highly liquid futures markets, and we may have price discovery from futures to spot. This is, I was happy to see Bahattin said a similar thing to that too, actually. Now, to cut short, I will give you one sentence from Sergei Komlev from Gazprom Export. This is one of the articles I think he wrote in 2010 in Gazprom magazine. I like it very much because it summarizes the views of speculators. He says, the choice of a commodity as a financial asset does not increase its physical demand, but it does increase its price. So this is the whole debate, actually. Now, commodity prices cannot be determined only by fundamentals, meaning supply and demand. So investments of market participants, call it hedgers or speculators, who are not directly involved as well as directly involved with the oil market, are important in determining or shaping the direction of oil prices. Now, we have two parts. We have current market conditions, current supply demand, that we don't know exactly. We are in April, for example. We do not know production consumption numbers for April. We cannot know. We are inside. We may have some rough estimations for March, a little bit better data for February, but much better data for April 2018. But 2018, 2 years ago. You see what I mean? We do not have good knowledge of market fundamentals of today. We don't have good knowledge of market fundamentals of last month. So we are lacking information, especially high frequency data. Now, market sentiment, that is why it becomes important. The expectations for the future. We know more or less current market fundamentals. We had OPEC meetings, okay? We had some cut in production, yes, but we also have fears for the future, which what I'm saying here applies also today. We have fears of coronavirus. We have concerns that demand is collapsing, basically, and we have a lot of risks. So we have a risk premium, and all these risks shape our future expectations, and these future expectations is reflected in the positions you are taking in the futures market. You know, you are selling short maybe because you think that the situation is getting bad. Now when we have a pathetically poor, radically revised, incomplete market fundamentals, and we have also the perceptions of dominant players. Bahattin mentioned this herding. This is extremely important. Just one example, you know, playing in futures market or stock market is not everybody's individual expectations of a particular stock, whether it will go up or down. No, you also look what the big guys are doing. For example, in Turkey, in BIST, in Turkish Istanbul Stock Exchange market, what the market players would look is that, for example, what the big players are doing, what is Merrill Lynch is buying or selling, for example. This is a good indicator. And because you think that Merrill Lynch may have much better information than you. So they know something probably that you would think, because they are big guys. So the markets, in my view, are inefficient today because there is a market efficiency hypothesis. You know, it assumes that everybody has the best knowledge and best information, and best information is available to everyone. No, absolutely wrong. Today, not everybody has the best knowledge, access to best knowledge at the same time. No, some big guys have prior knowledge to big events, and they can take positions before. I give you one example, because this is my last slide anyway. One specific example, I give you 30 June 2009. What happened to 30 June 2009? It was a Sunday. And there is a specific guy, I give you, Stephen Perkins, was working at PVM. It's a big broker. So he had a nice golfing weekend and had a lot of drink. And he went home drunk, and then he realized in the middle of the night that he had an order to place. but it is Sunday and he's drunk and he doesn't want to go to work. What he did is that he opened the computer, because you can put the orders through computer, and he entered some orders. Well, first some buy orders and some sell orders, etc. Suddenly, between 1:22, I'm looking at the document, between 1:22 a.m. and 3:41 a.m., so we are talking about the night connecting Sunday to Monday morning, he entered 7,125,000 barrels of Brent oil equivalent contract with a nominal worth of $520 million. Now, a drunk guy gets on the computer and gives orders, buy, sell, etc., net positions worth $520 million. And another guy at the time sees that somebody is buying 500 million barrels per day of contracts. It is Sunday. Monday morning, should something happen? That is why probably this guy knows something, and he started to buy too. And what happened? The prices jumped more than $2 in a few hours. Of course, the morning, suddenly the company realized that they had that much orders, etc. And anyway, so the rest of the story I explained another time. So he was suspended and got 5-year prison time, etc. But the issue is that a drunk guy can get on the computer, place orders, and moves the market $2. Well, you say that what is $2? You should look at the price at that time. So $2 is, even today is a big amount, but moving $2 in a few hours, it is not very easy. So supply demand, market fundamentals, absolutely nothing. So that is why I conclude that yes, in the long term, supply demand, market fundamentals play a very important role, but we cannot say that speculators have no weight in the market. Well, maybe they cannot, of course, set the prices, but they can show the direction of the oil prices. So in other words, they don't set the price, but they may intensify a price movement beyond or below what the market fundamentals warrant. So that is why I end up again with Al-Naimi. We cannot say only supply demand, or we cannot say speculation has no role to play. No, at times speculators are probably leading. Some in the long term, yes, it is supply demand, but in the short term, we cannot prove, I think. Thank you.
Well, Dr. Karbuz, thank you for excellent presentation. I missed that drunk guy event. So can you go back to slide 15? Professor Büyükşahin, we are waiting you as well to comment. So this fall, this big drop is completely motivated by fundamentals based speculator activity. I'm not talking about rise here, but we are talking about the fall here. This fall.
Well, we are talking about 1 month.
1 month. So
this is 1 month.
What do you think? What's your answer to that one? This is the price crash. Okay, there may be two-way speculation: price rise and price crash. We got the drunken guy story. Okay.
But it's 2009.
Okay. How about this one, Professor Büyükşahin? What do you think about this one? His thesis about it.
Yeah. Thank you so much, Sohbet. Great presentation. And of course, I have a lot of disagreement with you on some of the facts here, but let me tell you here first. Let me start here. Of course, we have, as I said, we don't have good quality data from physical markets. We always have revised data and everything. You suggested here, okay, we didn't have much change in supply and demand, but why we are seeing all this drop from 100 to 57? This is because what's called your expectation. It is not the current fundamentals. It is the expectation of the fundamentals. I remember those days, especially after Lehman demise, everybody was telling about, oh, it's the end of the day, at the end of the world. Basically, in the US, we have seen about 3 million barrel decline in gasoline demand on that one. And then still, basically, the expectation of much lower depression actually, and it lead to price collapse over there. Of course, one thing also, I'm not talking about day to day, they can change the prices. They can impact the prices. What I was showing is, are they able to systematically change the prices? That is my hypothesis. That is
No.
for sure no.
I agree completely with you. Yeah. Systematically, all the time, no.
The question on the poker table, it's not a good example over there, because you have to think about futures market like this. Okay, if I give you an example on that one, Barcelona versus Real Madrid playing a soccer game, and I am betting on that one. Do my bet impact this result of the match? Of course not, unless you give to Madrid players to cheat, because futures market versus spot market or physical market or stock market are completely different. You are totally right. Okay, there is no demand or supply constraint. There is no constraint on the supply at all. I can write as many contracts as possible, as long as I find a buyer at a given price. Basically, you can increase the open interest from crude oil futures market from 0 to 1.5 million contract, which is 1.5 billion barrel in a one day at a given price, same price. There is no need to increase the prices, because it is not a futures market, it's not a stock market. There is no number, certain number of unlimited. You can write as many contracts as possible. That is the beauty of it. If you're a drunk guy, I mean, it is a drunk guy, yes, he can impact the prices, but very short term. When people realize this one kind of error trades, market itself correct immediately. I have a paper on that one, error trades. Sometimes you have a fat finger. You can, instead of 1,000 barrel, you write 1 million barrel. And then what happens in market? Even before market announced that there is an error trade, market realizes one and then starts making the correction. That's why you cannot expect, I mean, of course, in my opinion, you cannot expect speculators impacting oil prices for a long period. I totally agree with you that as long as poor data is coming, you cannot produce the right fundamental value. I totally agree with you, because there is no correct data. As you suggested, consumption data is changing daily. I mean, also supply, it was supposed to be perfect, or inventory, only inventory data coming reliable from the US. Even that one is revised.
Even that.
Okay.
I don't have any problem with that.
Okay, now, okay, say it.
Okay, one more thing. I agree on the interest rate. I mentioned on the macro variables, that is really, really important, and especially during 2008, and then further on, especially with the shale oil, guys, current situation, interest rate is a big determinant of shale production right now. That is for sure. For others also. And one more thing, or the Al-Naimi, only Allah, God knows, and we, no, I didn't, of course, make some research on whether Allah knows or not, but I did make research on their fair price. They always announce, oh, fair price of oil should be $80, should be $75, should be $120. What we did on that one fair price announcement by Hawk or by dovish OPEC members, they did just follow market prices with a lag. There was no new information at all. It didn't impact the prices at all unless they acted on it. If they don't act on it, just talk. Talk is cheap. They can talk.
Yeah.
It has no impact on oil prices, given OPEC.
Okay.
Or something. It doesn't have. Sorry.
What I want is we are now closing the YouTube session. Sorry for the YouTube viewers. Why? Because I want my students to chat with you one-on-one. So we close YouTube now. And then I want you to stay here for 10 minutes. Let's just give a break like 5 minutes. Then come back here. And 10 minutes, if the students have some burning questions, answer that. And then we'll continue. Gökberk, you can close the live session now. Goodbye.
Actually,
Okay.
we have one question from YouTube to Sohbet Hoca, and it says that on the slides 15, what happened to the term structure? Did forward prices also drop?
Well, this is Brent futures prices, front month futures prices from investing.com. So term structure here we cannot know at that time. I don't have the spreads. What was the spreads at that time? I have no idea.
So we have found something that Sohbet Karbuz didn't know. So we
I think nobody knows, because what is that here is, how can I change this share?
Don't worry about it. I believe that it was an excellent presentation and has given the right message. And combining yours with Bahattin, we know that it's not an indicator of the real future prices. It's just a price discovery mechanism. Therefore, the aim will be important. That's why Sohbet is a good investigator. When you ask a question, he really questions it and goes to the end, just like the other academics. Maybe we can stop here because I want my students
Do you see this? What I see on the screen? Anyway.
All right.
All right.
Not sure whether you were seeing my screen or not. Anyway.
Okay, we have seen it. So we are closing the session now, Gökberk. Let's close.